The economy still has some bright spots, among them a booming stock market, falling oil prices, and promised pay raises at big companies. Still, recent data is not looking good. Gross domestic product contracted over 2% in February. That was the biggest drop since a year ago, and the numbers suggest growth will shrink further in the first quarter of this year. Now, that would be the third contraction in the past 4 quarters. Weak private and consumption and household spending are the biggest culprits. Well, private consumption accounts for 60% of Japan's economy. Joining us to discuss Japan's economy and the Bank of Japan's action is Ed Rogers. He's joining us live from Tokyo, the CEO and CIO of Rogers Investment Advisors. Ed, great to have you back on the show. Thanks again for joining us.
Thanks very much for having me.
Ed, Shinzo Abe's economic policies, or Abenomics as we call them, have been in play for 2 years now. Well, they're still not working. Average household spending dropped 2.9% in February year on year. Consumer spending, which makes up 60% of Japan's GDP, is taking a big hit because of that. Why has Abenomics failed to get household spending up?
Well, I think we'd start by saying we would caution viewers and investors to take 1 or 2 data points and extrapolate from that Abenomics has failed. 2 years into what is always, we have said, a 5 to 7 year process, because you need 5 to 7 years to undo 25 years of deflation. I'd say 2 years in, the report card's actually not so bad at all. When it comes to individual statistics, it depends on the numbers you look at. Spending in Tokyo department stores up 5.5% in March.
But GDP doesn't seem to bode that it's working either. Granted, it hasn't had enough time to kick in, but GDP's contracting. There's talk about deflation on the horizon. Which parts of Abenomics have been successful then?
Well, you've had over 1.1 million women join the workforce. So Womenomics is working. That's a central plank. You've had significant change in the structure of corporate Japan, much more attention being paid now to positive changes in corporate governance. You've had the GPIF commit to putting hundreds of billions of dollars to work in the stock market. That's very much a reflationary measure. You've had the Bank of Japan and Kuroda-san firing off bazooka after bazooka, making it very clear to the market that they are going to support asset reflation. So in the macro sense, we think there are a number of things you could point to that actually say it's not just working, but it's working quite well. Unemployment is at 3.5%. It's technically, there's no unemployment. That's the economist definition of no employment. There's no excess capacity and there's no excess labor. So wages are going to start going up as we've seen.
I'm glad you mentioned the stock market, Ed, because the Nikkei is up 12%, it's beating all the US indices. Why are we seeing such a rally in the Nikkei? What's driving that?
Well, it's beating U.S. equities because U.S. equities are clearly overpriced and have been for some time, we believe. That's what happens after 5 years of, reflationary policies led by the government. Japan is really still at the beginning of doing what every other government did back in 2009 in response to the global financial crisis. Japan, in addition to responding to the global financial crisis, has also got to undo 25 years of deflation. So we think that the actions by the Bank of Japan and Kuroda-san are highly appropriate, and they will be effective over time. And we think that investors are starting to realize that, and that's bringing them back to the Japanese stock market, which is in a relative sense very undervalued to other
So you think Japanese equities still have some
G7
room?
economies? Certainly.
You think Japanese equities still have some room then? How much further do you think they can rally?
Certainly there's room to rally. This is simple supply and demand. The vast majority of international investors remain underweight or zero weight Japan. So you have the long-only world that's really, they're just closet index trackers, most of them. And they've had zero weightings in Japan. So now that Japan's significantly outperformed the United States, you're going to find periods of significant jumps in long-only investment into Japan because they're mostly just index trackers, and they have to get exposure to Japan because it's so outperforming the U.S. market right now. And that becomes that'll feed on itself over time.
And I wanted to touch a little bit on oil. Japan is a net importer of oil. The downward spiral in oil prices, on the one hand, you could say that that's been good for Japan's economy, but on the other hand, has it been more of a negative by making the prices of goods stay low and interfering with efforts to fight deflation? What's your take?
Sure. No, you raise a very important point with respect to GDP and CPI. Again, with Japan importing over 90% of its energy after the Fukushima crisis and all the nuclear power plants getting closed down, the price of oil has a dramatic impact. And the fall from 100 down to 40, again, very, very deflationary in the short term. But in the long term, in the medium term, as far as making it easier to produce goods in Japan more cheaply, it's fantastic for this economy. But again, this is why we're cautioning against reading into minute, discrete data points and declaring that Abenomics has failed. If you're, again, look at the data points you're citing and just be careful. That's all we're saying about extrapolating that, oh, because oil's gone down to $40 and therefore, it looks deflationary for Japan, that means that the Abenomics reflationary policies are destined to fail. Over the medium and long term, this makes Japanese manufacturing much, much more competitive. It will feed the production of manufacturing in Japan, and that will be positive for the Japanese economy and Japanese labor.
All right. We'll keep a bigger picture in mind. As always, thank you so much for your insight, Ed Rogers, CEO and CIO of Roger Investment Advisors in Tokyo. We're out of time.